Hi, and welcome to this week's look at the major news stories affecting the market so far. And what are we going to be looking at this week? Well, we're going to start with the Great British Pound's reaction after we had the inflation report out in the UK on Wednesday. We're also then going to take a look at the euro and how that seems to be testing some key support levels ahead of the ECB meeting on Thursday afternoon and their next rate decision. Then we'll take a look at natural gas, see what's been happening with the price of that over the last few weeks. And we'll finish off, as we often like to do, with an equity and a bit of a tumultuous week for NVIDIA. So, what happened to the Great British Pound after the inflation report on Wednesday? Well, the CPI report was released, and that showed that inflation is in fact decreasing at a faster rate than analysts had predicted. The yearly CPI came in at an actual figure of 1.7%. The forecast was 1.9%, and the previous month was 2.2%. So, quite a large discrepancy, if you like, between the actual and the forecast. Yearly core CPI, now that's the CPI data, but that excludes energy prices and food, that came in actual at 3.2% against a forecast of 3.4% and a previous figure of 3.6%. So in terms of inflation, better than expected figures. So how do the currency markets respond? Well, with a decline pretty much for the Great British Pound versus pretty much all the others. That's because market participants are clearly assuming now that the Bank of England has stronger reasons to consider easing its current monetary policy aimed at curbing inflation. There was expectation that we'll be seeing a 25 basis point cut next month anyway, and a lot of belief now with this lower figure coming in that it could be at least 0.25%. Worth noting there is talk in the market that we maybe expect a slight increase in the CPI next month due to rising energy costs. Off the back of it, cable, so that's the Great British Pound against US dollar, dropped to its lowest rate in nearly 2 months. Now, if we take a look at the chart, see what the technical analysis can show us, the price dropped below that psychological level of 1.3000, 1.3 the figure, as we say. It fell beneath the lower boundary of the ascending channel that you can see in blue, which have been relevant since May 2024. Now, resistance could be expected after breaking that line. Bearish momentum was expected to continue into the US trading session later yesterday, or Wednesday, I should say, with concerns it could fall further to around the 1.29 figure. Now, where the lower boundary of the descending channel is becoming clearer on the chart, as you can see. Well, we actually saw a close around the 1.298, 1.299 mark on Wednesday evening, and Thursday morning signs of trying to test the psychological level of 1.3000 again. But it's fair to say it's quite choppy out there. There is volatility in the currency markets at the moment, so don't forget your risk management techniques. Okay, so we've seen what happened to the Great British Pound after the latest inflation figures. And at the moment, the euro is testing, or certainly was testing on Wednesday, key support levels ahead of the ECB meeting their latest decision. Now, at the start of the week, the dollar continued to strengthen across almost all fronts. Euro against the dollar fell below 1.0900. Cable, as mentioned, tested 1.300 this morning and had a fall off after the inflation data on Wednesday. And dollar against the Canadian dollar briefly traded above 1.38 the figure. Let's get into it a little bit more. Euro against the dollar now. Technical analysis on the chart indicates the possibility of further declines as a double top pattern has formed on the daily time frame. Full completion of this pattern may lead to a test of the 1.0800 down to 1.0790 range. The nearest area for corrective growth is between 1.0950 and 1.0900. Now, the price is going to be heavily influenced, we believe, by key events coming up. In fact, on Wednesday saw the German CPI report and a speech by Christine Lagarde, but probably slightly more important, Thursday, 12 o'clock midday GMT +3, we've got the Eurozone CPI report coming out, and fundamentally important, 3:15 p.m. and again GMT +3 on Thursday afternoon, the ECB rate decision, with experts predicting a rate cut of 0.25% or 25 basis points, bringing it down to 3.25%. Now, off the back of those figures, if there's any sort of surprisingly big numbers, a little bit like we saw in the UK, a further rate cut, or a larger rate cut if you like, and the ECB thus announcing further monetary easing, we could see an awful lot of volatility in the euro. Could well see some quite major spikes if that happens. So again, don't forget those risk management techniques. In terms of another euro pair, euro against the Japanese yen, the sharp rise in the price of the yen observed towards the end of the summer was interrupted by statements from the Bank of Japan Governor Ueda, indicating that Japanese officials won't rush to raise their interest rates. So the euro against the yen's corrective growth allowed the pair to retest that key range of 163.70 down to 163 the figure, although it's yet to break firmly above those levels. If we take a look on the daily time frame, range trading is being observed at the moment between 163.70 and 162.00. Now, if the price falls below that 162 level, a test of September lows around the 160 down to 158 mark is possible. However, if the price does secure itself above 163.70, an impulsive rally towards 166.6 down to 165 range may resume. Again, what comes out of the ECB rate decision and the meetings will be quite key to that. So yeah, don't forget those risk management techniques. Okay, now we're going to turn our attention towards the commodity markets and natural gas in particular. And the natural gas price has dropped over 8% since the start of this month. Back on the 26th of September, we published an article on the website when we were analysing the XNG/USD or natural gas chart. And we noted that the bulls may be gathering strength for a potential attempt to break the psychological level of 3.00 in terms of price. Now, if successful, we said that could pave the way towards a yearly high around 3.20. Now, since then, the price of natural gas broke above that 3.00 level on the 27th of September, and in fact reached the 3.20 level on the 4th of October, after which it reversed downwards. So what was the driver in this bullish sentiment? Well, Hurricane Helen had minimal impact on natural gas processing facilities along the US Gulf Coast. That was a big concern at the time. Since then, we have had a further storm still being assessed, really. Adequate gas reserves were in place, ensuring sufficient supply. As we know, reserves are quite key to these types of markets. And we had earlier weather forecasts which were indicating a short-term gas demand at the end of September. And of course, we've now passed that point. So these factors all coming together to sort of help push the price down slightly. If we take a look at the chart, the upward channel shown in blue seems to have lost relevance. The bounce from the median line shown by the first arrow was weak. Now, then the attempt to re-enter the channel from its lower boundary, as shown by that second arrow, led to a test of the 3.00 psychological level, which acted as some quite clear resistance. So at the moment, there's no signs yet of the bulls trying to regain control on the chart. And if supply and demand balance remains unchanged, the price may continue its decline within the red downward channel, possibly to its lower boundary, and that'd be reinforced by former resistance at 2.65. But certainly the fear element of some of the factors we had a few weeks ago seems to have disappeared slightly. So an easing of natural gas prices, particularly as we come into the colder months, could be quite interesting for the markets. Okay, we're going to finish up this week and we're going to take a look at one of our favourite equities, or it seems to be, because we tend to talk about it quite a lot. And that's NVIDIA, and the share price fell more than 4%, missing a record high. Now, on the 12th of September, analysing the NVIDIA chart, we drew an upward channel, which is shown in blue, and noted several resistance levels were forthcoming, including the downward trend line, which is shown in red, and the psychological level at $130 per share. And the bulls managed to overcome this resistance zone with a strong candle on the 7th of October, and we're indicating that with an arrow. Afterwards, the price reached the median line of the blue channel, but sharply reversed on Tuesday of this week. That reverse was driven by a broader decline in US stock market, as investors perhaps taking stock, excuse the pun, in terms of their risk profiles after the initial earnings season results had come out, but also rumours that the US government is preparing restrictive measures which may well infect NVIDIA to prevent the export of high-tech chip manufacturing abroad. Now, obviously, NVIDIA is a global player, so anything like that could have a bit of a detrimental effect on it. As a result, the NVIDIA price dropped circa 4% Tuesday, just shy of the record drop set on the 20th of June. So what next? Well, we take a look at the chart. What does that suggest? Well, support could come from the zone formed by that strong bullish candle on the 7th of October. This area includes a combination of psychological levels at $130 per share and $125 per share. Around here, demand forces proved their strength, overcoming that red resistance line that had been in play for nearly 4 months prior, and it could be said that that line could well now become support. A bullish fair value gap can also be found in that area. So these are some relatively good indicators, and they do seem to be clumped around together. It might suggest a new attempt to set a record high. Of course, on the other hand, the bears are showing signs of control around the $140 per share psychological level. So I think it's fair to say there's a little bit of imbalance going on there. Not all doom and gloom. Most recent tip rank survey, 39 of 42 analysts suggesting buys for NVIDIA stock and have an average target price of $152.86 per share in the next 12 months. And it's also worth noting that it closed Wednesday at $135.72 per share, so it had reclaimed some of those losses from Tuesday. But as ever, as being one of the major drivers of the US stock market these days, NVIDIA is almost always in focus. We wish you luck with your trading in the week ahead. Bye for now.